This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on to this week's Postgame chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com. Click the red button that says Looking for the Downloads. Patrick, did the next leg down in markets already begin?
Well, looking at page 2, when we looked at that S&P 500, what we have to, reflect upon is the fact that that July-August rally was simply a retracement. It went to retest the 200-day moving average, which has often been a very good arbiter of bull and bear markets. And the fact that the S&P rejected and started to sell into September was certainly the first clue that the primary downtrend is still intact. But what really was the big tell was the big rally we had leading up to the inflation number. We had a very oversold market. We talked about this idea that the market could get a relief rally, and it did, but got above 4,100 on that bounce. But the inflation number reversed the trend back, got the trend right back down. And with the fact that every rally is being sold in lower highs, the primary downtrend remains quite intact. And as we have the option expiration coming up here this Friday, which is potentially going to hold the 3,900 level, which has a certain amount of strikes open there. But really, as we go into next week, the big question is will 3,900 hold? I mean, once we get under 3,900, not sure how we're not going to be double bottom testing 3,700 in a short order. And of course, once you have any sell cycle begin, you just really don't know whether or not it can just build downside momentum in a liquidity event and do something that really surprises everyone. Nonetheless, the bulls are in bad shape here, and the charts are quite weak and vulnerable. And so we'll be watching going into next week whether or not that 3,900 gives out.
Now, Patrick, I just want to revisit the seasonality of really bad market years. Everybody remembers October, but in reality, the usual pattern is that you see the top, the short-term top, not necessarily the whole market top, but the recent top would come probably in August sometime. Then volatility really gets interesting in September, and then October is when the market finally puts the bottoms in and you get the really big sell-off. Kind of seems like we're following that plan here. If I look at your chart, August there was a top. It wasn't the total top of the market, but it was certainly the top for the last 6 months or so. And now all of a sudden it's September and volatility is picking up, isn't it? What comes next?
Well, I always have issues with following an analog by date because rarely are traders rewarded for something so obvious. But the big variables to me, obviously, are the midterm elections. Will that in some way change the pattern as we're moving here forward? The reality is this chart is very negative, but I still am, if I was to kind of speculate as one of the alternative scenarios to an outright crash is we come back, retest the double bottom, and then see a market that calms down back to 4,000 going into the midterm elections. It doesn't have to be all downside, but could just be a big grind as well. So I don't want to, I know that there's some big names out there calling for that 3,000 test on the S&P, and while it certainly would make sense for the S&P at some point to get down there, I would give it a very reasonable chance that previous low also holds. So certainly on the short term, I'm negative, but not completely convinced on a full leg lower here in September. Eric, the interesting thing I wanted to just add to that is on page 3, I have the volatility in the index, the VIX. And what is interesting is we haven't yet seen a proper bout of volatility spikes that typically is associated with, a market fear and grabbing at premium to hedge downside risks. And while volatility has been following the vol path pretty clearly, and it's certainly nothing out of character, it is certainly in my mind, something that leaves lots of room for there to be one quick little washout to the downside of the market that is accompanied by some sort of a spike into the mid-30s. So it'll be really interesting to see whether that materializes.
Patrick, I think this is very much material to the title of this chart deck, which is Has the Next Big Down Leg Begun? It would be tempting if you just looked at the size of that huge red candle on the S&P earlier this week when we got the inflation print. Like, oh my God, this is it. This is the beginning. The sky's falling. Look at the size of that thing. But look, we got 2 more trading sessions under our belt now. We're just closing up the second one as we speak. And it's kind of stabilized. It hasn't continued. So it almost seems like we're back to this very orderly. The market has just discounted an unexpected result on the inflation print. It's priced it in, and it doesn't seem to be bringing a huge panic on the way I was afraid it was. Maybe in gold it's bringing on a panic, although it's kind of ironic that it's an inflation print that's bringing on a gold panic. But in equities, it doesn't seem like the panic is continuing, at least not in the last couple of days. But let's move on to the U.S. dollar, which is not quite on its highs, but it's almost back up to them. What do we see here?
Oh, the upwards channel is intact. Higher highs, higher lows in an upwards trajectory. If it follows the pattern it's established, a punch to a higher high toward 112 would seem like a very natural occurrence. It is interesting, though, that the U.S. dollar yen seems to have stalled out a little bit. But really, this, I think, will ultimately be as to whether the euro is making that journey down to like 97 cents. And so we'll be watching very closely as to what happens there. But what is interesting, if we go to pages 5 and 6, where I have the US dollar against the Canadian dollar, as well as the Australian dollar on page 6, what you can observe here is the fact that both of them are right at the edge. They've been going toward their key levels, and they're potentially both about to break out. And it'll be really interesting to see if that US dollar really gains some traction against these two cross currencies, and whether they start contributing to a Dixie increase. Moving on, though, Eric, let's talk about that oil chart. There was all sorts of headlines about whether the SPR was going to get replenished or not, which kind of gave oil a little bit of life. But so far, what we had was oil had a very clear breakdown below a pretty important support line that was established through July and August. And the entire rally that we had here in September has more or less stalled out on where all the previous lows were. And that is, unfortunately, a characteristic of a downtrend in this. And it really, at this moment, still makes oil vulnerable to some short-term weakness. Now, I get that bigger picture bull story on oil, but it really just doesn't seem like the chart wants to start doing anything bullish at this moment. It would be really interesting to see whether we have a downturn here that sees a very brief dip below 80. What's your take on crude?
Patrick, I think there's plenty of scope for a significant move down before we see a move up. And the thing you really have to understand is, what is the basis of my prognosis and Anas Al-Haji's prognosis and so forth for much, much, much higher oil prices to come? Well, the reason for that is that crude oil is famously demand inelastic, meaning that when the price increases, demand doesn't go down that much because most of the uses of crude oil are things that people have to have. They don't like it, but they have to pay for it. So that means that if we have a situation, as we have right now, where it is impossible for the oil industry to supply the world with enough supply to get back to pre-pandemic normal, that means that as you try to get back to pre-pandemic normal, energy prices have to go to the moon, and they will. The thing is, we're not pushing to get back to pre-pandemic normal. We're in a very difficult economic situation where the economy is floundering. The S&P is on the verge, it looks like, of breaking down to a new lower low. And we've got serious concerns about inflation plaguing the economy. There's lots of reasons to think that there's going to be enough demand destruction to hide the coming energy crisis, maybe for another year before it really kicks in. My very firm, high conviction contention here is that when demand tries to return to normal, there's not going to be supply there to meet it, and prices are going to the moon. But it looks to me like there's plenty of reason to expect demand to continue to come off, and that's going to hide this problem, potentially for a while to come. Eventually, it's going to be much higher. Now, it will be very interesting to see whether the Biden administration changes their tune, because when they announced that as soon as we get down to 80, they're going to start buying to replenish the SPR, that kind of puts a floor under the market if people think they really mean it. So I wouldn't be surprised if after someone explains to the Biden administration how markets tend to interpret their comments, if they walked that back and said, well, that's not really what we meant. We meant that we would start considering it as we got well below 80, or who knows what they're going to say. So I don't know where this goes. I'm convinced that we are at the beginning of an energy crisis where energy and access to energy is going to be critical. And, we could go for the next year without any really big run-up in prices, or Putin could pull half of his oil off the market tomorrow morning and we'd be at $150 before we know it. So it's very hard to tell what's going on here. And what that means is all the smart traders are saying, look, I know it's coming someday, but I can't afford, especially with this kind of huge volatility, I can't afford to put big positions on the table and speculate, because I don't know how long it's going to be until that outcome comes around. I certainly have dramatically reduced the amount of leverage in the longs that I'm still carrying in the crude oil market, because I know I have to be ready to ride out some really big vol swings. As long as people are thinking that way, there's not going to be a lot of speculative interest. It's the day that changes and everybody starts to say, wait, things have stabilized. We now see that there is a clear path toward testing the limits of supply. I know what that's going to do. It's time to pile in on the long side of this trade. When that happens, it's going to be scary. But it could be 6 months to a year away for all I know.
All right, well, let's move on to the gold chart. And really just the only thing here to highlight is that there's that clear breakdown of that July low. And more importantly, it doesn't show on the chart, but it's also the breaking of the 2021 lows. And this, in my mind, does open the window for a drop all the way towards 1600, which is just a reasonable first target, somewhere 16 and a quarter or something, just for the short-term impulse. But it'll be really, I think, a story of when will the dollar top come in. Because if we have the dollar index heading up to 112, 113 and stays strong for months, well, then I think gold has even further potential weakness. I do think that there will be a pretty clear correlation and at least a window from which, when the dollar inevitably hits its short-term high, will mark where gold turns. And so right now, with the dollar remaining so strong and immediate trends so distinctly in the favor of the U.S. dollar bulls, on the short term, gold weakening here is really the path of least resistance, and I'm anticipating a little bit more weakness here.
I agree, Patrick. And, there's always scope to say that maybe markets love to just, retest a low just before reversing higher, before a new structural bull market begins. I think that would be wishful thinking in this case. It sounds good, but are there really catalysts in play for a new structural bull market to begin right here in gold? Or are we going to see a washout down to 1,600 or maybe even 1,400 before eventually this changes? And even then, what's going to change? The dollar will not be forever, but the dollar, I think, is going to last and appreciate longer than most people expect. We're going to see over the next few years that as the global economic situation and the geopolitical situation deteriorates, that the dollar is still the cleanest dirty shirt. It's the benefit of the safety trade. The dollar is going to appreciate. Someday it will be replaced with a digital currency system that will change the landscape forever, but that's still many years off. Patrick, you've got three charts pretty much using up the rest of the deck here, which show us different bond indices or different bond yield related instruments. What's going on here?
Let's start on page 9 with the 10-year U.S. Treasury bond yield, which, like we were talking about in the market wrap, is edging along that high. And to me, this is really interesting because if we have, let's say, bonds break down as the yield goes ripping north of 3.5, and then this trickles into the investment grade and high yield markets, which are on page 10 and 11, I don't know how the stock market doesn't take this poorly, particularly on page 11 when we look at the high yield junk bond market. It always has a strong correlation to equities. And the idea that, for instance, high yield junk is breaking to fresh lows and making another leg lower, and somehow the stock market is going to buck the trend. I'm a big seller on that. And so watching whether or not these bonds all start breaking, even investment grade bonds are about to make a fresh new low here. And watching whether or not there's another leg lower in bonds coming in early next week is on my mind, because it's going to be really hard for the S&P 500 to hold up if this entire bond complex is taking another full leg lower.
Listeners, if you enjoy Patrick's chart decks, you can enjoy them every single day of the week with a free trial of Big Picture Trading, Patrick's trading service. You'll find the information on pages 12 and 13 of the chart deck, or you can just go to bigpicturetrading.com for a free trial.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.